So today we're going to track the secret journey of something you've probably signed but maybe haven't thought a whole lot about since, your mortgage. I mean, where does that mountain of paperwork actually go after you get the keys to your new home? Well, let's dive in and find out.
Okay, picture this. You did it. You signed on the dotted line for a 30-year loan. Your bank just handed over a huge pile of cash for your house. But let's flip the script for a second and think about it from the bank's perspective. All of their money is now tied up for decades. How in the world can they turn around and lend to the next family that walks through their doors?
Well, the answer is this fascinating, absolutely enormous, and pretty much invisible financial engine called the secondary mortgage market. This is the place where your original lender, the primary lender, can sell your mortgage to get their cash back, like almost immediately. It's the system that keeps the whole housing market liquid and, keeps it moving.
So here's the basic journey in just 3 steps. First, you get your loan from a primary lender. Simple enough. Second, that lender turns around and sells your mortgage on this secondary market. And third, the new owner of your mortgage bundles it up with thousands of others and uses them as collateral to issue bonds. And just like that, your mortgage has been transformed into an investment product. And that brings us right to this key term, mortgage-related securities. It's really just the umbrella name for those bonds we were just talking about. The crucial thing to get here is that the mortgages themselves, the promises from homeowners like you to pay back your loan every single month, that's the actual asset backing these new investments. Now let's get a little more specific. One major type of these things is the pass-through security. These are often backed by a government-owned corporation called Ginnie Mae, which, adds a nice layer of security for the investor. When an investor buys one of these, they're basically buying a direct slice of a pool of mortgages. They have what's called an undivided interest, which is a fancy way of saying they get their share of the principal and interest payments as homeowners pay them each month. All right, the other big player on the field is the mortgage-backed security, or MBS. Now, this might sound kind of similar, but there's a really critical difference. With an MBS, the investor buys a bond that pays interest. And yeah, that interest comes from mortgage payments. But, and this is the key, the investor does not have a direct ownership interest in the actual mortgages. They own the bond, not a piece of the loans themselves.
So let's just put them side by side because this is really the core distinction. With a pass-through, you own a piece of the mortgage pool. With a mortgage-backed, you own a bond that is backed by that mortgage pool. It seems subtle, but legally and financially, it's a really, really important difference.
And hey, if that term mortgage-backed security is ringing a bell, well, it should. As this quote points out, the whole practice of bundling up and selling risky, or subprime, MBSs was a central cause of the 2008-2009 global financial crisis. It's a powerful reminder of how this secondary market, when things go wrong, can have massive real-world consequences.
So the market has these relatively straightforward securities. But what happens when different investors have different appetites for risk? I mean, not everyone's looking for the same thing, right? Can you create more customized products from just a simple pool of mortgages? Well, the answer, of course, is a big yes. This is where financial engineering gets really creative. Enter the collateralized mortgage obligation, or CMO. A CMO takes a huge pool of mortgage-backed securities and literally slices it up into different pieces called tranches. Each tranche has a different priority for getting paid back. So, for example, a pension fund might buy the safest first-in-line tranche for its low risk, while a hedge fund might snatch up the riskiest last-in-line tranche, hoping for a much higher return.
And believe it or not, it can get even more specialized. Financial engineers can strip these payments apart. For instance, an investor who thinks interest rates are going to fall might buy just the interest-only strip. Meanwhile, another investor who expects people to pay off their mortgages early might buy the principal-only strip. These are highly specific tools for very, very sophisticated investors.
Okay, so we've talked about the what, all the different types of securities, from the simple to the super complex. But who are the who? Who are the major institutions that are actually buying up all these mortgages and creating these financial products?
The 2 names you'll hear the most are, of course, Fannie Mae and Freddie Mac. Now, what's really interesting here is their status. They were started by the federal government to get this whole market going, but they are not technically government agencies. After they nearly collapsed in 2008, they were put into this special legal status called a conservatorship, where they're now overseen by a government agency, the FHFA.
All right, so now that we've met the giants of the housing market, it's worth knowing that this powerful idea, creating a secondary market to keep credit flowing, it isn't just for homes. It's actually used to fund other really vital parts of the economy through a whole world of specialized federal credit agencies.
This table gives you a real quick snapshot. You've got the Farm Service Agency helping farmers directly.
You've got Farmer Mac, which is kind of like a Fannie Mae, but specifically for farm mortgages. And then you have the Federal Financing Bank, which helps finance other government agencies you might not expect, like NASA and even the U.S. Postal Service.
And here's a great little piece of trivia just to clear up a really common confusion. There's an entity in this world called the Financing Corporation, or FICO. But, and I can't stress this enough, it has absolutely nothing to do with your FICO credit score. Zero. This FICO was created way back in 1987 to help clean up the savings and loan crisis.
And let's bust one more common myth while we're at it. You've probably heard of FHA and VA loans. A lot of people assume that these agencies are out there buying and selling mortgages. They're not. The FHA and the VA are in the insurance business. They insure the loans, which makes it way easier for certain borrowers to qualify, but they don't directly participate in buying or selling those loans on the secondary market. So after all that, what's the big takeaway? It's this. This incredibly complex, often invisible secondary market is the engine that allows lenders to keep lending. By turning these long-term loans into tradable securities, it frees up capital that can then be used to finance new homes, new farms, and even fund parts of the federal government itself. But it leaves us with a really critical question, doesn't it? This system is a powerful engine for economic growth, but as 2008 proved beyond a shadow of a doubt, it also carries enormous risks. The same complexity that allows for customized investments can also hide some serious dangers. So the lingering question is, how do we best balance the benefits of this powerful financial innovation with the absolute need for public safety? Something to think about.